Alright, so I'm going to continue covering the downtrend. Hopefully finish this study up a couple of days or by the end of the week. Anyway, so where was I? Right here, where you see these two bars. Now this action again, I'm just going to cover it. Over here you had to change, you had your climax, Y, biggest volume, on and up bar, followed by change of behavior, which did what? It validated the climax. How did it validate the climax? It shows buying on the way up and, selling on the way up by strong hands into weak hands and selling on the way down. Why is that occurring? It's occurring because the buyers are being filled up until they can't be filled up anymore, and then selling on the way down because you have to sell. If you can't sell on the way up, what do? You sell on the way down at worse prices. But the prices are still good, relatively speaking. You know, profits are made. Sell on the way up, sell on the way down. This is also expressed as FOMO buying, meeting professional selling. This is FOMO buying, climactic, meeting professional selling. And over here, panic selling, meeting professional buying. So that's what happened. After that, you had this bar. What did this bar mean? Its expansion in range meant that the buy orders were withdrawn. Because the buy orders were withdrawn, the next buy order is much lower. So that's why you have a gap or you have wide range, because the buy orders are being withdrawn. Let's say they're being withdrawn in 50 and 49. Then the match buying and selling will be met at 48 because 49 and 50 have been withdrawn. So that increases the range. So price goes from 51 to 48 because 49 and 50 orders at 49 and 50 for buying have been withdrawn. So it expands the range. So that's what this is happening here. Those supporting orders are being withdrawn. Market continues to go down over here, breaking the first line of support over here. Then what happens? It rallies for one bar and goes down. This is climactic action. Why is it climactic action? Because of the significant increase in volume. And it is confirmed by the rally up, which is confirming that this was a climax on the way down. So this bar is confirming that was a climax on the way down. By climax, we mean not the traditional climax that you're all taught, but climax meaning in the high minor climaxes that occur at rally highs and pullback lows. In this case, you have a bear rally down and you have a climax that occurs 2 bars later. What's interesting is that typically you'll have the climax on the lowest bar of the rally down. Instead, it came here on the 2 bars later, which actually is a higher low. So understand that there has to be variation in climaxes, and this is indicating that. Okay, so I'm going to do a later video where I just go into climaxes in this study in detail. But that's the point. Then it rallies up, it goes about halfway back. You'll notice that this, all it did was test the breakdown bar, right? All it really did, and it went halfway back. After that, it made a lower low. Very important, lower low. Also, the volume in these 1, 2, 3, 4 bars is heavy volume relative to the pullback volume here, here, here on all the bull pullbacks. This pullback volume is greater. Another indication of bearishness because volume is expanding, relatively speaking or comparatively speaking, to prior pullbacks. After that, it attempts to rally, but it creates a lower high. What's important is you have a lower low and you have a lower high, and that these 3 bars together are very important. Why? This bar that made the lower high increases in volume, meaning it's climactic. It is climactic. All right. Now, typically, that climactic bar will be confirmed by the bar afterwards. All right. And in this case, if you have a bear climax, the bar afterward should be a red bar. You have a green bar climax here, minor climax. It should be a red bar, but that red bar came a little bit later. So these are all variations in climax. The first variation we talked about was right here in a minor selling climax. And why is this a variation? Because it didn't occur on the lowest bar, it occurred on the test. It was high volume. And again, these are not my words, these are Wyckoff. And if you're not familiar with what I'm saying, it's because we've been trained to think a certain way about climaxes and stuff, which are sometimes consistent, sometimes inconsistent with what Wyckoff originally taught. Anyway, so this is one variation. The second variation of a climax that he talks about is right here. In this case, the climax is confirmed based on the action of two bars, which indicate that the closes are unable to hold. So here you have the reversal, okay? It doesn't occur right after the climax bar, this being the climax bar. It occurs 2 bars later, right there, where the close of this bar is lower than the close of the prior 2 bars, helping confirm the climax. Also, taking a look at the net gain of those 3 days being not good, being lost, right? And this is like hesitation, meaning, what does he say about hesitation? It's unable to make progress after the climax. This is the climax. Does it make progress after the climax? Is very little in terms of thrust, very little in terms from close to close, and all lost right on the bar afterwards. So the hesitation right after the climax is one situation, and a reversal bar after a climax is another situation, but both helping to confirm the climax. After that, you had all this sideways movement. Again, this is showing hesitation because the closes are tight, there's no net progress, and it's just unable to take out the high, defining very clearly a lower high from this prior high. These highs are lower. After that, you have this breakdown bar on increasing volume with a low end close, which is steadily increasing in volume. Not abruptly increasing in volume, but steadily increasing in volume. What does that mean? It means it's going to take out the former support levels. This helps us forecast that the support level will not hold. Anyway, so that's where we're at. I forgot my place. Somewhere here. Here. Here you see the steadily expanding volume over the next 2 sessions, which tells us in advance, basically forecast, that the former lows, meaning support, will not hold. All right, so the downtrend is unmistakable, continuing almost without interruption. A brief rally on the 31st and a small 2-day rebound from the old 28th support level. Where's 28th? Right here somewhere. This support level is going to crack. on April 4th and 6th emphasizes the weakness. Notice the shrinkage of volume. All right, so I'll just move on to the next chart. April 4th. April 4th. So that's April 4th and that's April 6th. So the bounce here is under 1 million and under 2 million. There's significantly small volume on the attempted retracement or pullback back up. That's a problem. Next, following several days of holding within a narrow range from the 7th to the 14th inclusive as the average approaches the supporting points with no evidence of any selling climax nor convincing rallying power. All he's saying is it's tightening. Alright, so that means just, I don't know how else to say it. You just have those closes that are tight, meaning they go up and down, but there's no net gain on either side. So it's just holding, and we'll talk about later on why you're going to see this behavior all the time. Before move down, it holds, and this happens on point figure 2. You can tell the reason why it's holding is because there's additional distribution being done in a tight range. They want to hold the price there so they can distribute more and more and more at around that price. So this is why you'll see this all the time. Anyway, so where am I? No convincing rallying power, but as the average leveled off and then drifts to a dead center. This is also important because the concept of a dead center, many times he's going to talk about it later. He keeps talking about a hinge. You know, that dead center is the hinge. All right. So sometimes, you might hear apex or triangle. Those are patterns, but they mean the same thing, and they just don't consider all these other factors that Wyckoff considers. So over here, for example, he considered there's no selling climax and no convincing rally. So the averages level off and then drift to a dead center on the 11th. We may reduce our stops and short position to a point or two above the halfway recovery from April 7th low. So why is he reducing the stops? Merely to guard against an unexpected change in trend. Why? When prices go into a dead center, as you know, they violently go one way or the other because there has to be movement. They just like tighten until one side overtakes the other, and the winning side will move and the other side will cover. So anyway, so he's putting the stops lower because what if there's a change in trend? But instead of rallying vigorously away from the dead center after 6 days of apparent support, the market tells us there's no buying power by its inability to enlist higher lows. That's what he means right here, high support, or materially expanding volume when it tries to follow up the advance of the April 13th bulge. So where's April? Okay, right here. The attempt to go higher fails. How do you know? Take a look. What does he say about this? But instead of rallying vigorously away from the dead center, there's still no buying power by its inability to enlist higher support or materially expanding volume when it tries to follow up the advantage of the April 13th bulge. It's just saying, there's no ability to rally. Like, look at this range, tight, attempt. Even here, like here, you have a high and close. So this right here, because it closes above the prior, it looks like it closes above the prior 2 bars, and the volume, it does expand here, but the follow-through totally fails. it just goes up, and even on more volume goes down and takes out the close of 1, 2, 3, possibly 4, 5, I think 5 prior bars. That's not good for the bulls. Alright, so now he goes into, increase our short line and pyramiding and all that. So he believes in pyramiding, adding to your shorts. But this is not an easy thing to do, especially holding large positions means you have to have some skill. Anyway, high volume on the 28th. Okay, one second. Talking about here. All right, let's go over here. The surge on the 28th. Holy shit. Yeah, I can't read this shit. The surge on the 28th, if we consider, so it's 4 million volumes, so 4 would be right here. Right there, I think. 4. Okay. Alright, so he's doubling the volume, so it would be, I think it would be this. This would be around 2 million. So it would be this. So this, he's doubling volume because in those days, Saturday was a trading day. And the volume was always low. So what he would do in his mind is just double it. So that's what he's saying. Saturday volume has doubled, but obviously this is not the case now. Should not be mistaken for a selling climax. The distinguishing difference between this day's relatively large volume increase and prior volume surges is the latter appeared after an extended or well-developed downswing. What does that mean? It means that the swing has to be, let's say you have a swing high. If that swing high is just 1 or 2 bars, that's not a climax. The climax is not going to come there. You need to have multiple bars. You have like bar 1, bar 2, bar 3, bar 4, and then bang, climax. Or even on a pullback from a rally, price pulls back, bar 1 down, bar 2 down, bar 3 down, bar 4, bang, climax. It won't be, okay, 1 bar down is a climax. There has to be movement. All right. So just to give an example of that. Yeah, I think this is a good example of a pullback. You have bar 1 down. This is second in the swing, third, fourth, fifth, and then bang, climax, 6th bar. In this case, you have 1, 2, 3, 4, 5, 6, bang, climax. Over here, you have a movement from 1, 2, 3, 4, 5, and bang, climax. Here you have, I don't know where to take it from, but I would assume it would be from this low. 1, 2, 3, 4, and bang, 5, climax. So this, for example, is not a climax. It's just the start of the move. But if you continue this move 1 bar, 2 bar, 3 bar, 4 bar, and then, like over here, sharp expansion, that is not a breakout, by the way. It shouldn't, there's a difference between climax and breakout. Sharp expansion, it could be a climax. Okay. Abrupt expansion, typically not steady expansion. So what is he saying? He's saying there has to be a well-developed swing. All right. Whereas the comparatively high volume on March 28th accompanied by the penetration of the trading range and therefore indicated a large increase in supply stimulated by the breaking down of lines of support. All he's saying is when you're breaking support or resistance, the high volume is a breakout. it's coming as a result of breaking a level, because it takes effort, it takes volume to break levels. So don't think that that is a climax. There's two different things, two different behaviors. One breaks levels, the other is in movement, and then a climax comes. Okay, so both, the similarity is obviously both have high volume or increasing volume or abrupt volume. They can have abrupt volume, but one breaks a level, the other it ends a move that is in progress. To clarify this, and this is extremely important principle, folks. This is very, very, very important. This is a principle that he lays down. I suggest anyway, a sudden or abnormal increase in volume appearing after a given price movement has been in progress usually indicates the end or the approaching end of that particular movement. Whether it's a rally or a pullback, whether it's a rally up or rally down, or a pullback up or a pullback down, whether it's a wave up or a wave down. The sudden or abnormal increase, two important words, sudden or abnormal, I was saying abrupt, whatever. Sudden or abnormal increase in volume after movement is in progress, meaning the wave is in progress, terminates the move, terminates the wave. That's different than if unusual volume appears when price is breaking through a well-defined trading range. It's a breakout. Okay, so if unusual volume appears when price is breaking through a well-defined trading range or a zone of congestion, the abnormal volume more probably indicates a continuation of the price movement in the direction of the breakout or the breakthrough or the breakout. Thus, if price works up to the top of the trading range and breaks out on large volume, the inference is that somebody is willing to absorb all of the offerings. They're going to absorb it to push prices at a higher level. All right? And vice versa. Whether they're going to do it or not, or whether they'll succeed or not, we don't know. So do not use this mechanically. And what he's meaning is, don't just code it. You know, it's very easy to code a price volume increase over a swing high or a swing low. If you do that, you're going to get breakouts on every single move. And that's not a good thing. So he says what you need to do is use judgment, because in the case he describes, it's moving to resistance and then breaking out. Price is going higher with higher low, higher low, higher low to a resistance level and then breaking out, absorbing the overhead supply. And that is one type of behavior, meaning absorption behavior. The second is price goes to a level of support and resistance and breaks that well-defined level. All right, and that level or congestion range. Congestion range is just like a small tight range. All right, so that's also breakout. Now what's the difference? The difference that, or the key thing that he's harping on is one is continuation while the other is termination or the end. They're totally different. Climaxes end the move or tell you of an approaching end to the move, meaning end. That movement up or down is going to end, versus that movement is going to continue to go in that direction. All right, the end is obviously climax, and the continuation is obviously a breakout. right? But he says, do not use a hard and fast rule. In fact, this is a problem. This is why breakouts, you just look for high volume at a level and say, oh yeah, I'm going to buy it. They fail. Because there's too many other factors. Therefore, you must not attempt to apply the above principle in a mechanical way, meaning don't code the indicator, nor is fixed to a hard and fast rule, but consider it only in conjunction with other technical manifestations. Again, what other principles? Obviously, trend matters, right? So trend is one. Second is, a lot of times you're going to have breakouts into a support level. They will fail, or resistance level. So you just have to know that. A lot of times, you see many times there'll be a pullback, which is a breakout. And I don't want to go into all that, but a lot of times you'll have, for example, this bar. You see how it's increasing in volume and spread, and someone might see a downtrend and see, oh, now it's coming down. It broke this low or broke this low and it went on high volume, because they're not considering trend, meaning the higher high, the higher low, and another higher high. And they're not considering that this is going right into a support level right here, or that it's against this ease of movement bar, or that it's against this high and there's pressure coming here, or that this is a climax right here, this minor climax. So this is why, if you just look for, okay, let's see price and movement expansion across on, let's say using a wave chart. So you have a wave high and you see price pull back and then go up to that high and then expand on price and volume. And say, oh, this is a breakout, without considering that background, that context, things like follow through, things like prior tests that failed or passed. It's impossible to judge the probability. Also the time frame. If it's like a 1 minute chart, a 2 minute chart, 3 minute chart, 5 minute chart versus a weekly chart, there's a big difference. Anyway, so the whole point of this entire paragraph is to understand the difference between continuation and the end of a move. All right. Where am I at? All right. With more short sales, some or other stocks which promote to exhibit the greatest weakness, these sales can be protected by stop orders. I went through this. So liquidating market. Okay, so what's the important point over here? The persistent increase in volume from April 11th to April 16th. So this is also a very important concept. Understanding the concept of liquidation. You see over here, 11th, okay? Now watch the bars after it. Higher, 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 higher. See all of that? Those 1, 2, 3, 4, those higher, 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 and higher bars. When price goes into a certain direction and it has increasing volume like that, what does it mean? It means, like in this case, it is liquidation. All right? That's what he's saying. This concept is the persistent increase in volume from April 11th to 18th accompanied by the lower prices, meaning as price is moving, more volume is coming in, is a characteristic of a liquidating market. What's the behavior? It's liquidation. And so long as volume continues at about this level or higher, there is little danger on the short side with systematic stop loss protection as indicated above. I'll go ahead and stop for the later section because it's too much to focus on. But the idea is understand what liquidation is. Liquidation is on the downside when as price is moving down, the volume keeps increasing or is at about the same level. That means it's liquidation. This is the opposite of volume that is tapering off. Liquidation versus volume that is tapering off, which is what? It is a decrease of volume as the move is continuing. Liquidation is the increase of volume as the move is going down. There are occasional sharp rallies evidently made by short covering, such as whatever. This kind of buying kept the volume up to around 3 million shares, but as we will see, by the performance of May 1st, such advances are quickly lost because when the numerous shorts have covered, no buying power remains to take the place of this demand, and the market underneath proves hollow. So all he's saying is you got sharp rallies. What is causing sharp rallies? When you have a downtrend, many times you see sharp rallies. You look at any market, especially crude, you see the sharp rallies come up. The sharp rallies are a behavior. What is that behavior? It is the behavior of short covering. How do you know it's short covering? Because it never has any follow through. You know, it's like 1 or 2 bars and it's dead. That's how you know. All right. This kind of volume kept the volume up to around 3 million shares. But as you will see, performance of whatever May 1st, the advances are quickly lost because numerous shorts have no buying power, have covered, and there's no buying power remains. So it's hollow. So I'll give you an example. You see this? This is short covering. Yeah, it's a spike up, but where's the follow through? Nothing. What happened? 1 bar wonder. This is the result of short covering. Why does the price go up that much? It goes up that much because those sell orders are being the short covering. So they have to buy. So the shorts have to buy. When they buy to realize a profit, it creates a big bar up. And after 1 or 2 days, it's back again to selling. All right, bang. You see again, you have this bar on a watch. Straight down. Where's the follow through? And again, no follow through. So the 1 bar wonders are short covering 1 to 2 bars typically. You'll see many times you have a rally down, and then it's pulling back. When on the pullback, you have this sharp bar. Watch for the follow through. This is no follow through. Also, as you've learned from my prior session, this is climactic. Here's the climactic volume that's bigger than 1, 2, 3, 4, 5, and almost double some of them. And what is that principle that we just went through telling you? Well, this is a reversal. This is a pullback. So the pullback 1, 2, 3, 4, 5, 6, bang, climax, confirmed by the bar right after it. It's going to go down. Why? Sellers are coming in. So this is where is this? This kind of shorts have come. All right. Oh, there you go. Volume of April. Oh, okay. So let's go back to April 23rd. Okay, this volume is very high. Okay, so now he's going to talk about this bar and this volume. He says the volume surge of April 23rd implies a possible selling climax. Of course it does. It implies it. All right. Which suggests that in view of the extent of the decline to date and the fact that the average has now come down to the important December support area, we might expect a corrective rally. All right. So if you have high volume like that, again, according to that definition we read before, as a movement is in progress, you get that high abrupt volume. What does it mean? The move is about to terminate. Very likely it's about to terminate or come to termination. So the rally is being terminated. So after a rally being terminated, what do you expect? The start of a pullback, because the rally is followed by a pullback. A normal rally would be halfway back to the April 14th. Again, normal halfway back. You've heard many times in Wyckoff, halfway back, halfway back. This is where it's coming from. So a normal rally would be a halfway back retracement or pullback to the April 14th high point, which in this case would be up to the small rally top, or to 146. Because of the previous bearish behavior of the averages and the likelihood that we are in a liquidating market. Again, what does liquidating mean? As it's going down, the volume is increasing. All right. So we do not regard this 1 day's slender evidence of high volume, nor the possibility of a corrective rebound, as threatening to our positions. Here you have to compare evidences, bullish and bearish evidences. Obviously, this right here expresses a bull move is about to start, meaning a wave up is about to start. Now, will that wave up change trend? Well, on the bearish side, hell no. Why? Because you're in a liquidating market and the trend is down. All right, so he's weighing evidences. On the bearish side, he's saying that the bearish behavior is that we're in a liquidating market, and this is a 1 day bullish bar. All right. So all we know is that, okay, this 1 day bullish bar may have a corrective rebound, and we'll observe the corrective rebound, but chances are it's not a change in trend. It's just a corrective rebound because of the strong evidence we have on the bearish side, which says that we're in a liquidating market. Why does it say that? Because as price is going down on the down wave, the volume is increasing. So don't be scared of your short positions. However, if we wish, we could put the stop down, lower the stop. When it fails to rally, as might be expected, but instead sinks back almost immediately to close at the low points with no shrinkage on volume, we recognize that this is vulnerable to fresh selling pressure. Why is it vulnerable to fresh selling pressure? Why is it vulnerable? When it fails to rally. Why does it fail to rally? Because look, one, then bang, back down. It failed to rally. So it fails to rally, be expected, but instead sinks back almost immediately. It just goes right back down at the low points with no shrinkage of volume. I don't know what he's talking about over here. I think he's talking about there's no shrinkage of volume on this bar, because in the prior bar there's shrinkage of volume. Here it increased. When it fails to rally as expected, all right, and no shrinkage on volume on the 25th. Understand? It does shrink in volume. Anyway, with no shrinkage of volume on the 25th, we recognize that it is vulnerable to fresh selling pressure. So the point that's making is that if there's no shrinkage of volume, when you see the case that there's no shrinkage of volume and price is continuing, it's continuing to be bearish. The sharp rally of the 30th, it's a little bit hard here, but here you go, puts us on guard. However, for now, we observe that the downward thrusts have been shortening since the 28th. So what is he talking about, downward thrust? Low to low to low. So these three lows, the downward thrust on these three lows have been shortening. That is between the 27th and the 30th. The bottom show a tendency to rapid off or flatten out. So this is the concept of shortening of the thrust. He's come to it again and saying that it's flattening out, meaning the rate of decline is diminishing from low to low to low. From the standpoint of the major trend, the breaking of the December lows puts our other indications as still bearish, but the slackening of downward progress on comparatively heavy volume also warns us to be on the lookout for a possible minor turning point, meaning a minor climax. In other words, a technical recovery which may later prove to be the beginning of a more important change depending on how the market behaves during and after the indicated recovery. So there are some bullish indications. What are they? From this bar to this bar to this bar. The the shortening of the thrust. And that shortening of the thrust is occurring on quite high volume. All right, it's pretty high. It's not small. And he's saying that you need to keep in mind. How come the shortening of the thrust on all that volume, or above average volume, let's say you take a 20 or 10 or 20 period, and you see the volume is quite high on the current bar relative to a volume average. So it's high, and there's not a lot of progress in terms of low to low to low. So just be on guard of a reversal or a minor turning point, and that's what comes in this 1 bar wonder. Observe how the rally beginning May 2nd and running to the 4th and 5th is accomplished on markedly decreased volume. So from this bar to this bar, look at the volume. This bar from here to here. Is that anything like the liquidation that we saw? No. It's decreasing volume on the pullback, meaning it's a low volume pullback. Bearish. Showing that whatever demand existed in the expectation of a recovery from the former December support level is not willing to follow prices up. What does it mean when you have a low volume pullback? So you have this 1 bar wonder, and that's followed by a pullback on decreasing volume. So yeah, you got a 1 bar wonder which has good volume. After that, looking at the entire wave, you see lower volume. It means that the demand or the short covering that made that 1 bar wonder has evaporated. It's not willing to chase prices up. Very important. 1 bar has a lot of volume. Many bars later don't have high volume. They have very low volume. So you cannot consider 1 bar in isolation. And this is the mistake many people make when they're looking at a candle pattern. And a lot of times just looking at that 1 or 2 bars, when obviously it's like 7 or 8. So he's observing the entire pullback and separating the 1 bar from the rest as an outlier. So the meaning is it's unable to follow price back up. Such support is more likely to be due to short covering than a re-entry of substantial buyers. The rally, which begins May 7th, lasts only 3 days until the 9th, and that day's close is around the low, which shows that the bulls have exhausted their buying power. This bar is the 9th. It's a low-end close. Again, he looks at closes, whether they're high-end and low-end. So what he's saying is when that pullback is going, what happens is the rally, which begins March 7th, lasts only 3 days. It lasts for 1, 2, 3. And what about it? The close is at the low, which shows that the bulls have exhausted. Okay? And we'll talk about this a little bit more, but because there's much more evidence than a low-end close. From the 11th, the downward march of prices is resumed, and the volume again increases on the downside, showing breakout of fresh liquidation. Again, you see this concept of liquidation, meaning when you have a down rally followed by a pullback, followed by continuing movement back down on increasing volume, it is evidence of liquidation. All right. Liquidation should give you a lot of confidence that markets are not going to just go the other way. So the probability of a directional move is much larger on the downside when there is liquidation going on. And here you have fresh liquidation. Why? Because the pullback is done. And after the pullback, you have volume coming in as the move is continuing down. Notice the complete failure of any tendency toward hesitation or rally as the average touches the low. Is there any evidence of hesitation here? Does it go sideways? Is there a lack of progress from close to close? No, it's just going straight down. That's very bearish. No hesitation as it goes to the critical lows. Compare this action to the prior action. I'm not going to do that, but the idea is look for hesitation. If there's no hesitation, hey, it's going to go through. All right, now I'm going to go to a footnote. Additional indications of the weak characteristic of this rally. What rally? It's this pullback. This bear pullback right here is weak. How do you know? Well, first is the 1 bar wonder followed by the low volume. The low volume, right? The low volume after the 1 bar wonder on the way back up means that buyers are not willing to follow prices up. But what else? The volume surge on May 8th, right there. See that? The volume surge of May 8th is confirmed as a minor buying climax. These are his words, not mine, right? Right there, minor climax. Saying again and again and again, bringing up the same concept of climax, terminating both the rally and the pullback. Where did it terminate the rally? I don't know. It tried to terminate it here, but the rally sucked. Then again, not over here. But it did it on the pullback right there. You can see it's sudden. Why is it sudden? Look at the 4 or 5 bars before it. They're almost formed like a pattern, meaning they're like the same, right? Around the same. All of a sudden, bang, right there. This is climactic. So the two pieces of evidence that you have here that the pullback is done is 1, the climax, and 2, the reversal right after it, helping confirm the climax. 2, the average runs into resistance under the former temporary supports of April 17 to the 21st. Resistance created by the offerings of buyers who mistakenly judged the lows to be the bottom are now anxious to get out even on the up wave. Okay, therefore we have another selling opportunity. All right, so he's going to sell this in anticipation of a resumption of the major decline on the secondary reaction to the April lows. Where are the April lows? The April lows are right here. What is he saying? He says from this low, you had an attempt. Green bar, what happened afterwards? Down. Is there any type of juice here? No. What does that mean? These buyers who attempted to buy, they're trapped. This green bar is trapped and this green bar is trapped. You had to move down. Ding, 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 ding. Oh, the buyers come in. Okay, this was a support level. Let me see. I'll buy support. They try to buy. 1, 2. Any damage on the upside? Zilch. What happened? Goes straight down. So it goes back up here into that same area where these guys try to buy. Again, green bar trapped, unable to do any damage, goes right back down. They go in that same area. These guys that are trapped want to get out even. So that level where they're trapped adds to the short thesis that A, you'll have fresh selling or liquidation, and B, it will be compounded by existing trapped shorts. Very important to understand where those shorts are trapped. They're trapped here on the green bar, probably here too. So anyway, just draw a support level and see price tag it. And that's all you got to do. All right, so I've gone over this. I'm going to stop now, and we're on page 7 and page 19. Take care. Have a good weekend. Bye.